a global stock portfolio. You short a global stock portfolio or a global index.
So I try to explain that
Stocks
shorting
will go down, whether we have an inflationary outcome, as the gold bugs predict, or a deflationary, as I predict, more like the 30s. Either way, stocks will go down. Stocks don't like any crisis, any downturn in the economy. They don't like high inflation. They hate deflation. So the best place to make money in a downturn, it's just more risky than holding a 30-year Treasury bond to me for everyday people, would be to simply be short stocks.
See, it
unleveraged, just short. Betting on stocks going down.
You can. Let me to the listeners. Let me tell you how dangerous shorting is. Bitcoin went up 5 million x. A lot of people shorted it. They all lost everything because your downside is infinite. So if you had bought Bitcoin at $1 and sold it at 50,000, you made 50,000 bucks. But if you had shorted Bitcoin at 50,000, it wrote it down to $1, which it never went to, you'd only have made...
Richard, that's crazy. Just stop that logic. That means if you held it forever. I'm not saying hold any of this forever. I wouldn't even hold it a couple months if something changes in the wrong way.
You're looking
at
it
short for a period of time. Stocks have gone up so much. The more any asset goes up, the less it can go up just because it's bigger. Anything bigger grows slower than in the early stages. So that
the parabolas disprove that.
You could go to zero. That would take forever in stocks today, and I wouldn't be in stocks. The longest I'd be short might be a year or two.
I'm saying that if you look at the price chart, the history of all shorts is that they lose all of their money in almost every price chart because they print the money for free. As long as these price charts we're looking at are denominated in dollars and they're printing the dollars for free.
So you give me, Richard, your recommendation. Let's say I'm right. We're going to have some sort of big downturn.
Yes.
Just that one assumption. It could be inflation. What is the one thing you would have people buy to make money in a downturn?
Stable coins. You buy stable coins. So right now, well, yeah, because they're tied to the dollar. But so
wait, you hate the dollar.
Yeah, but they have.
Richard, what are you talking about here? You hate the dollar. You don't want anything in dollars or paying in dollars.
Yes, but it has advantages that the dollar doesn't have. So when you take $1 to your bank account, you have probably some taxable income problems, don't you? There, yeah. So depending on what jurisdiction you live in, it could be the case that if you sold an asset for dollars, maybe you live in a jurisdiction where that's not a taxable event. And then maybe you can just stick that in decentralized finance, which is currently paying, depending on where you're trading, 40% APR because people are borrowing it for leverage to get long. So in DeFi and Ethereum, you can take a stable coin and lend it out with just smart contract risk, no other counterparty risk. There's no AML, no KYC, no sign-up risk, no a global overlord that can be like, that's not your money, we're taking your money, none of that bullshit. That's all solved. So you just do have smart contract risk. You got to make sure, you got to hope the code works right. And you can get in between 6 and 40% per year sitting on your fucking cash with, depending on where you live, maybe no taxes.
How
long
have stable coins been around?
4 years, maybe. They actually trade more volume than Bitcoin does.
When Bitcoin crashed in 2018?
Yeah, they were there. Yeah.
How did my first test, and because you could be right about this one, sounds more reasonable to me. Yeah. How did they do in that crash? Did hold their value go up or go down?
They're basically always about $1. They usually hold their pegs very well.
Okay, so that's a way of not growing your money. You're not going to make money on that.
Well, 6 to 40% a year is good APR.
The dollar is going to preserve your money, which I'll give you is at least a possibility.
Yeah.
Okay.
No, the reason
that makes sense, but you're not going to make. How are you going to make money?
Well, you make 6 to 40% per year APR, just because what happens is you're putting your stable coins into the lending platform, and then people are borrowing those to sell them for crypto to get long crypto. And then they get wrecked and liquidated, and then they have to give them back. And then you get your coins back with interest. And so traders being ruined is what allows people that lend out stable coins to be profitable. So, if you tried to lend out Bitcoin or Ethereum, you get no interest. You get 0.15% instead of 6% because, it's harder to get a hold of these stable coins. And right now, more people want to get long because it's a parabola, and people love to buy tops. They absolutely love it. They hate buying bottoms. They love buying tops. So if you believe that the markets are going to crash, I think getting into stable coins like DAI, which has no counterparty risk, just smart contract risk, or USDC, which does have counterparty risk. They can seize your coins when they want, but they've only done it once or twice upon the government commanding them to for some legal thing. And they've got more trading volume than Bitcoin has. Tether does more trading volume a day than Bitcoin or any other cryptocurrency. That's how popular they are. So stablecoins are actually the most popular cryptocurrencies, even though they're
real quickly,
not real.
You say, okay, so you get interest, because that's like a bond, only sounds better. How much interest you say you can make on that?
Depending on the platform that you're in. I mean, right now you're averaging about 7% everywhere. So if you have USDC or DAI and you put it in DeFi right now, you're getting 7% per year. And you can withdraw instantly. It's not locked. So you can make 6% APR today and pull it out tomorrow. Now the fees are very high.
That sounds attractive to me.
Yep.
Let's say this downturn lasts. The typical crash I'm talking about is 2 to 3 years. Over 2 to 3 years, 7 and 7, you could make 20-30% interest and have something that's not going to fluctuate in value.
And then you can buy the bottom. Yeah, and then you can buy the bottom. See, so my belief is that statistically, the likelihood that you called the top is very low compared to all the things that looked like tops, the false peaks.
That is very unlikely to call it top.
Right, exactly.
Give you that.
And those people that get it wrong, if they open any kind of short, they are fucking annihilated. So being in cash, you're not going to get annihilated.
Hey, Richard, you got to back up. These people are shorting Jesse Livermore or whoever, traders on leverage. I'm talking if somebody's going to be short this time, they are unleveraged short in a broad index. But you still lose it all for 2x's. You lose all your money in a 2x. You're wiped out.
Yeah,
I'm not
but even without leverage, with no leverage, if the market 2x's, you lose all your money. If you have 0% leverage,
no, you will not.
You do.
Unless you stay in for 90%, then you'll lose 90% of your money. And anybody who stayed in over 3 years when it goes against you would be an idiot.
But look, we just did. When you look at these dips, if you shorted the 20% dump in equities, you're now missing a third of your money with no leverage. If you just shorted with no leverage the bottom of the 20% dump we went up, fucking 30, 40% from the dump? So you're missing 30 or 40% of your money, and then you're just where we are now? Shorting is a terrible way to try and make money. Get flat with no risk, because it's very impossible to get the top.
Okay,
flat and then buy the bottom. Buy the bottom.
I don't recommend shorting to most people.
Yeah.
Stocks are even more volatile in downtime. Aggressive people I do, if you know what you're doing. But if the reason, that's the reason I like a 30-year treasury bond, you're getting some interest, not 7%. You're getting a little over 2%, but this is locked it in for 30 years, and that's where the leverage is if things go down. So now,
when you want to get out of your
7% reliably with little or no downside.
Yep.
That's as good or better. I would agree with you. That's as good or better, because even that 30-year treasury bond, if rates keep going against you, then you're going to lose some money too.
Yeah, and I think they can keep
lock
printing
in your value and make 7% a year. I think that is an excellent. I just don't know that because I'm not an expert in your area.
It's really easy.
If you can do that, that's an excellent strategy.
I mean, I could show you how to do it in 10 minutes. It's very easy. You go sign up on an exchange like Bitstamp, Coinbase, Kraken. You buy yourself some USDC, and you can put it on a whole bunch of different platforms. I can walk you through it. It's very easy. And then when you think the bottom is hit, you can get long if you want, or you can just buy back the spot. And look, Bitcoin's up.
I tell you, I hate to say it. I mean, one of the best things in the next boom, just like the internet stocks, are after they got annihilated in 2000, 2002, they were the best investment. Buying Amazon.
Yep.
would have been like the one hindsight stock. So if I was into the crypto blockchain thing and I'm using stable coins or something like that to preserve and make some money in the downturn, I would go, first place I would reinvest is in the leading blockchain crypto arena.
Well, I mean,
because there's going to be a big shakeout. You got to know 8,000 coins are not going to be around in 5 years.
Well,
history says that.
The funny thing is, so if something has product market fit, it's very likely to stick around. So Bitcoin has dumped 90%, 80%.
There were 100 auto companies that had great product market fit and ended up with 4. 20, 30 years later.
Maybe.
Richard, this is just basic business. A lot of new companies enter in an innovative, high-growth industry like this, and they get shaken down to the best for the efficiency of the economy and benefit of consumers and everybody.
Yeah,
so there's nothing wrong with that.
But
the industry can't succeed if it lets every loser stay in.
That everything's an S curve. So, for instance, MySpace was replaced.
Expert on S curve. So
yeah. So MySpace was replaced by Facebook.
I'm just saying.
MySpace,
one of my biggest principles.
MySpace was replaced by Facebook. Facebook is being replaced by TikTok and would have been replaced by WhatsApp and would have been replaced by Instagram, but they fucking buy them all. So they're breaking the S curve just by merging and acquisitioning them. So, yes, you do have first mover advantages. Yes, you do have critical mass. Yes, you do have network effect and Lindy effect.
I like the second movers. I like a bunch of companies to start and a bunch of them fail, and then somebody smart jumps in.
Well, there you go. Well, I got great news for you. I invented a second mover. I invented my own cryptocurrency. Right? Yeah. It went up 352x this year. Then it dipped. It's dipped 6 times, 80%, 70%, 60%. It dips constantly. But that's what happens is people love to buy tops and sell bottoms, and then they just give their money to the people that buy bottoms and sell tops. This is one thing that Warren Buffett says.
Traders give their money to the smart.
Yeah, the impatient pay the patient in the markets, all of them. And so Hex basically does that, and it pays you. So I told you how to make yield on stable coins. Hex pays you yield, but it's not a stable coin. So the average yield in Hex, it's the first economic instrument in the world ever where people are locking up millions of dollars for 15 years at a time and they cannot get out. So if you buy your 30-year bond, you can sell it. You can get the fuck out. You're not in for 30 years. But if you lock up your Hex for 15 years, you are locked for the 15 years, unless you want to lose a lot of money. If you want to lose a lot of money, then you can end your stake early. So if you end it at half the time, you lose all your interest, but you keep your principal. And if you end it at less than half the time, you get murdered with fees and penalties, and it benefits all the other stakers. So I took the time deposit in a bank, and I just copied its parameters, and I put them on the blockchain. So if you look at your bank and you look at CDs, they pay you 20% more interest every extra year longer that you lock. I just copied those parameters. I said, okay, in Hex, we're going to have a constant rate of inflation, just like Bitcoin does. So right now, Bitcoin inflates at like 1.89, something like that. In the 10 years that existed before that, when it went from a penny to $20,000,